The United States debt is so bad that if every American paid $1,000 a month, it would still take 8 years to settle this $35 trillion debt. But the scariest part is, it is growing at astronomical rate of $1 trillion every 100 days.
Meantime, the federal debt load snowballing in recent months, adding about $1 trillion every 100 days and currently sitting near $34.5 trillion in total.
So today we're going to explore how the debt has spiraled out of control, why it's a big deal, and what it means for you. Let's get into it. Hi, my name is Yernar. Welcome to the channel where we break down the world of economics and finance. If you're passionate about these topics or just want to stay informed, make sure to hit that subscribe button and stay updated with our latest insights. Early 2023, the US was rapidly approaching its debt limit of $31.4 trillion. The Treasury Department warned that without an increase, the government would run out of money to pay its bills by June 5, 2023. This looming deadline created a tense atmosphere in Washington, with both parties scrambling to find a solution. It was either the country offloaded some of its debt or raised the limit to avoid catastrophe. It has since grown to a mind-blowing $35 trillion, making it the highest debt in recorded history. This immense debt is a major concern, and here's why. You see, the reason why most countries borrow is due to budget deficits. This happens when a country's spending is more than its annual allocation. This is a common issue, especially with the US budget. Borrowing has become an essential tool for balancing the budget. However, this needs to be regulated, which is why there is debt limit to ensure it does not go out of hand. The US federal budget is the largest in the world by a large margin. In 2023 alone, the country had a budget of $6.3 trillion, which is a lot more than the next two largest budgets in the world combined. By comparison, China, which is number 2 in this rank, had a budget of $4 trillion, while Japan, which comes third, spent $837 billion. A substantial portion of the US budget is allocated to defense. The amount the United States spends on defense is so large that it surpasses the combined total of the next 9 largest military budgets in the world. Yet, the money spent on defense is not even the largest component of the country's annual spending. In 2023, $1.3 trillion was spent on Social Security, $889 billion on health, $848 billion on Medicare, and defense comes fourth with $820 billion. These are huge numbers, and they are not going down anytime soon, which means the US debts will keep growing. But how is it possible to have so much debt and yet keep borrowing with no limit in sight? The government debt functions differently from individual or household debt. If an individual owes a significant amount, it becomes increasingly difficult to secure additional loans. So, how does the US manage to keep getting more loan? The key lies in understanding government bonds. Imagine that US government needs money to fund various projects like building roads and schools or even paying off existing debt. Instead of just printing more money, which could lead to inflation, the government borrows money from investors by issuing bonds. These bonds are IOUs issued by the US Treasury, promising to repay the principal amount at a set maturity date. When you buy a bond, you're lending money to the government. In return, the government promises to pay you interest at regular intervals, known as the coupon. Treasury bonds are considered as one of the safest investments because the US government has never defaulted on its debt. They provide a steady income through interest payments and are less risky compared to stocks. Investors in these bonds include other countries, investment companies, and individuals. Some of the largest holders of US Treasury bonds are Japan, China, and the UK, making them the biggest creditors to the United States. And here things get interesting when considering the actions of creditors. While analysts say the US cannot easily pay off its debt, these creditors have the power to influence the government by selling off these bonds. Imagine a scenario where major holders of US Treasury bonds, such as Japan, China, and the UK, decide to sell their bonds in large quantities. While the Federal Reserve is not obligated to buy back these bonds directly from foreign holders, a mass sell-off could cause bond prices to plummet and yields to rise, potentially destabilizing financial markets and increasing borrowing costs for the US government. This scenario highlights the complex interplay between the US government and its creditors. In the first 5 months of 2024, China has dumped nearly $80 billion worth of US bonds, with $42.6 billion sold in May alone. This unprecedented volume of bond sales in such a short time is concerning, as it may prompt other investors to follow this trend. The reason why the US government has never defaulted on its treasury bonds is that they can borrow more money by issuing new bonds. While the Federal Reserve can create money to buy these bonds, known as quantitative easing, doing so on a massive scale, such as covering the entire $35 trillion debt, would lead to significant inflation and economic instability. Therefore, this approach is not a practical solution. They avoid this because there would be serious consequences if too much money were in circulation. The primary issue would be inflation, which is likely to snowball into other economic problems, such as the dollar losing its value against other currencies and crippling the nation's balance of trade. When we talk about printing money, it's not just about physically printing dollar bills. Instead, it often means the Federal Reserve creating money electronically. This process involves the Fed buying government bonds and other securities, which injects money into the economy. The largest amount of money printed in the United States happened in 2020, when Jerome Powell, the head of the U.S. Federal Reserve, announced that the Fed was removing the $1 trillion buyback limit on bonds and making it unlimited. This meant the government was now willing to buy back as many bonds as were available to be sold. Essentially, the Fed was buying treasuries from the market, increasing its holding of government debt.
The Federal Reserve now says there is no limit to the amount of money it is willing to spend buying up commercial debt.
Within a month of this announcement, the Fed had pumped $2.3 trillion back into the economy. But that was just the tip of the iceberg. In a year marked by unprecedented challenges and extraordinary fiscal measures, the United States found itself grappling with a deficit exceeding $3.1 trillion. To put this into perspective, this deficit is more than double the previous year's shortfall and represents a significant portion of the nation's GDP. Trillions of dollars were pumped into the economy through stimulus packages, unemployment benefits, and emergency relief funds. This included the CARES Act, which alone accounted for $2.2 trillion aimed at providing immediate economic relief. Deficits like these are what keep driving U.S. debt upwards. The government doesn't have many options other than borrowing to fund its expenditures. The other alternative would be to increase taxes. As you can guess, this only makes the administration unpopular. People want to pay less taxes but want more benefits from the government. This means the alternative of cutting expenditure is also not an option. If the government cuts spending, it means less money for schools, healthcare, social welfare, and a lot of other things people want the government to spend on. High spending has become a norm in U.S. government operations, creating a vicious cycle that seems impossible to break. To keep the circle going, the Fed often steps in to purchase Treasury bonds to support the government's borrowing needs. This practice is known as monetizing the debt. And as expected, the Fed's action led to one of the biggest inflations in the United States history. By 2022, the inflation rate had soared to 9.1%, the highest level in 40 years. While inflation is bad for us as consumers, it can actually be beneficial for the government because it serves as a strategic tool in managing national debt. Typically, government debt is issued in nominal terms, meaning the debt's value is fixed at the time of issuance. As inflation rises, the real value of this debt decreases because the money owed loses purchasing power. For instance, if a government owes $1 trillion and inflation rises by 5%, the real value of that debt effectively diminishes by approximately 5%. This phenomenon was notably evident after World War II, when many countries, including the United States and the United Kingdom, experienced high inflation. The post-war inflation significantly reduced the real burden of their massive war debts by the 1950s, thanks to the higher prices and wages in the economy. Inflation also leads to asset inflation, where the prices of real estate, stocks, and other assets rise. Consider the housing market. The median home price increased by over 25% from 2020 to 2022. If you were looking to buy a house in 2020 for $300,000, by 2022, that same house could cost you $375,000 or more. So while you feel bad about having to pay more money for your groceries, you would feel richer if you owned a house or other asset that has appreciated due to inflation. Similarly, stocks tend to appreciate as the cost of production for the companies rises, increasing the value of the company's stocks. Commodities like oil, gold, and agricultural products are particularly sensitive to inflation. Take crude oil, for instance. From mid-2020 to mid-2022, crude oil prices surged from around $40 per barrel to over $100 per barrel at certain points. Inflation also gives the Fed the opportunity to increase interest rates, which can generate more revenue for the government. However, this also means that new debt becomes more expensive to service. Despite these measures, none of them actually reduce the debt burden. Instead, they increase the need for the government to borrow more. This brings us back to why the United States had to increase its debt ceiling. Hitting the debt limit would have been disastrous, as it would signal that the United States is unable to continue borrowing. This would effectively mean admitting that the country can no longer manage its debt, which would be catastrophic for the dollar, as explained by Paul Ryan, the former Speaker of the House.
If the world concludes that America is not going to get its fiscal house in order, not going to get these entitlements under control, then they're going to conclude we're going to monetize our debt. And there goes dollar dominance. That's an exorbitant privilege that benefits us greatly. We're not acting like a world reserve currency. We should. And this, to me, is the biggest fiscal challenge the next president's going to have to confront. And I wish I could say somebody's got a plan for this. Neither of them do. That's what's so frustrating for me.
What is scary about the US debt profile is its ratio to GDP. As of the first quarter of 2024, the US federal debt stood at approximately 122.3% of GDP. This means the total debt exceeds the annual economic output of the country. The debt to GDP ratio has seen significant fluctuations over the years. For instance, in 2020, the ratio was 133%, a sharp increase from 103% in 2019. This spike was largely due to the economic impact of the COVID-19 pandemic and the associated government spending. According to the Federal Reserve Bank of St. Louis, the debt to GDP ratio is a critical indicator of economic health and the sustainability of government borrowing. High levels of debt relative to GDP can limit the government's ability to respond to economic crises and may lead to higher interest rates. Professor João Gomes, a finance professor, says he is not worried about the current level of debt. The real problem is that it is growing too fast and would likely double to become twice the size of GDP, which is when it becomes a significant problem.
I'm not worried about the level of the debt right now. Let's be clear. We can afford this level of debt. We can grow out of it. What I'm really worried about is it's going to double as share of GDP in 20 years.
The scariest part is the amount of interest that is paid annually to service this debt. While the government delays paying off its debts, it cannot default on paying these interests. The US is staring down a financial nightmare, with interest payments so far this year at $682 billion. The implications of this are both alarming and profound. Interest payments on the national debt have been climbing at an alarming rate, fueled by relentless federal borrowing and soaring interest rates. Just a year ago, these payments stood at $658 billion, but they are projected to skyrocket to $892 billion in 2024, surpassing discretionary outlays for defense. Such a dramatic rise underscores the unsustainable path of current fiscal policies, and the consequences are terrifying. The impact on the federal budget is nothing short of catastrophic. For every dollar collected in income tax, a significant portion is consumed by debt servicing. This leaves not much for other essential expenditures like defense, healthcare, and infrastructure. The nation finds itself in a vicious cycle where growing debt consumes an ever-increasing share of the budget, squeezing out critical investments needed for the country's future. The economic implications of this situation are dire. High interest payments severely limit the government's ability to invest in growth and respond to economic crises. The federal budget is under immense pressure, making it more challenging to fund vital programs and services. The shadow of this financial burden looms large over the nation's economic stability. Unfortunately, there is no light at the end of this tunnel. The Congressional Budget Office, CBO, projects that interest costs could soar to $1.7 trillion by 2034, nearly doubling over the period. This is the optimistic case scenario, and experts believe it could be much higher. This trend highlights why US urgently needs sustainable fiscal policies to handle the growing debt burden. Right now, this path is unsustainable and poses a serious threat to economic future of United States. The situation is critical, and fiscal reforms are needed as the nation teeters on the brink of financial catastrophe. Sadly, there's no easy solution. Americans will have to brace themselves for the economic storm ahead as the government continues to oil the debt machinery. And to be more ready, you need to hit the like button and subscribe. Thank you for watching the video. See you in the next one.